The S&P 500 has been a great place to invest for nearly a century, but there's a major issue with this index that most people overlook. That's right, there's a big problem that often goes unnoticed. In this video, we'll break down what that problem is and what you can do about it. The S&P 500 is a stock market index that tracks 500 of the biggest publicly traded companies in the US. It's often used as a gauge of how the overall stock market and economy are doing, and generally anytime someone refers to the market, this is what they're talking about. Since it's weighted by market value, the largest companies have the biggest impact on its performance. The index includes businesses from all kinds of industries: tech, healthcare, finance, consumer goods, and more, making it somewhat diverse. Because of its strong track record, a lot of investors use it as a go-to option, typically through index funds or ETFs, to grow their money over time. For a stock to be included in the S&P 500, it has to meet several key requirements. First, the company must be based in the US and have a market cap of at least several billion dollars. The exact threshold changes over time. It also needs to be highly liquid, meaning its shares are actively traded. At least 50% of the company's stock must be available to the public, and it must have positive earnings over the most recent quarter and the last year as a whole. The company also has to be listed on either the New York Stock Exchange or the NASDAQ. Even if a company meets all of these requirements, though, it's not automatically added. An S&P committee makes the final decision. What most people don't realize is that just because the S&P 500 includes around 500 companies doesn't mean each one has an equal share in the index. Actually, far from it. The index is weighted by market cap, meaning the largest companies have a much bigger impact on its performance. Right now, over 30% of the S&P 500 is made up of tech stocks, and a significant portion of that comes from just a handful of companies. Apple is the largest holding, making up roughly 7% of the index, followed by Microsoft at around 6% and Nvidia at about 6% as well. Amazon accounts for about 4%, while Facebook, now Meta, sits at 3%, and both Google or Alphabet and Tesla each hold about 2%. Altogether, these 7 companies make up about 30% of the entire index, meaning the S&P 500's performance is heavily influenced by just a small group of tech giants. Looking at the sector breakdown, technology is by far the largest, making up nearly twice as much as any other sector. It's followed at a distance by financials, which account for around 14% of the index and include major banks and payment processors like JP Morgan Chase, MasterCard, and Visa. Next is consumer discretionary at 11%. Covering companies that sell non-essential goods and services, such as McDonald's, Starbucks, Nike, and Booking Holdings. Healthcare comes in close behind at about 10%, with major players like United Health, Johnson & Johnson, and AbbVie. Communication services also make up around 10%, featuring companies like AT&T, T-Mobile, and Verizon. Industrials account for roughly 8% of the index, while consumer staples, companies that sell essential products people buy regardless of economic conditions, like Costco and Coca-Cola, make up just 5%. By the end of 2024, the S&P 500 has delivered an average annual return of just over 10% since 1957, which is pretty impressive and has made it a go-to benchmark for long-term investing. However, when you factor in inflation, the real return drops to 6.37%. Inflation eats away at the value of your returns over time, so while the numbers look good on paper, what you're actually left with after inflation isn't as high. This just shows why it's important to think about inflation when looking at how your investments are really growing over the years. The S&P 500's heavy focus on tech stocks can actually bring more risk than many investors realize, or any large allocation to any single sector, for that matter. While these big tech companies are huge parts of the economy and have made a lot of money for investors, they're not immune to market ups and downs. In fact, tech stocks can often be more affected by market volatility, like changes in interest rates or shifts in how investors feel about the market. These types of changes can hit tech harder than other sectors, and because they make up such a big portion of the S&P 500, it can lead to more risk than people might expect. An alternative to a traditional S&P 500 ETF is an equal weight S&P 500 ETF. These are funds that track the S&P 500, but with a twist. Each company in the index is given the same weight no matter how big or small. In a regular S&P 500 ETF, the bigger companies like Apple, Microsoft, and Amazon have a huge impact on their performance. But with an equal weight ETF, every company, big or small, influences the fund equally. The ETF is more balanced and less reliant on just a few big stocks. It can offer more diversification and might perform differently than a regular S&P 500 ETF, especially when smaller companies are doing well. When investing in the S&P 500, there are many different types of index funds and ETFs, each with its own focus and strategy. A popular one is an S&P 500 growth fund, which, as the name suggests, is designed to achieve higher than average growth and higher volatility. S&P 500 growth funds target companies that are expected to grow faster than the overall market, with an emphasis on capital appreciation. These funds typically invest primarily in tech stocks, which tend to have higher growth potential but are riskier and may not offer much in the way of dividends. On the other hand, value funds focus on S&P 500 companies that are undervalued compared to their fundamentals, like earnings or revenue. These funds tend to invest in more stable, dividend-paying companies and are geared towards slower but steady growth. A fund like this more closely follows the strategy of Warren Buffett. Income funds are designed for investors who really enjoy regular cash flow, focusing on companies that pay high dividends. These funds often invest in sectors like utilities, consumer staples, and healthcare, which are known for their reliable earnings and consistent payouts. Energy funds focus on the energy sector, investing in companies involved in oil, gas, renewable energy, and energy infrastructure. While they can offer attractive dividends, they can also be volatile due to fluctuating energy prices. Sector-specific funds allow investors to concentrate on certain industries within the S&P 500, such as tech, healthcare, or financials. These funds target areas they believe will perform well but come with higher risk due to the lack of diversification. Warren Buffett has been saying for years that most people should just invest in the S&P 500 instead of trying to pick individual stocks. He believes it's one of the easiest and most reliable ways to build wealth over time without a lot of hassle. He's even said that when he's gone, most of the money he leaves for his wife will go into a low-cost S&P 500 index fund because he trusts it to grow steadily in the long run. His main point is that even professional investors have a hard time beating the market, so the average person is better off just buying and holding the index. He's a big fan of keeping things simple. Avoid high fees, stay patient, and let the market do the work for you. The S&P 500 sector breakdown has changed a lot over the years. When the index first started in 1957, it was dominated by industries like manufacturing, energy, and consumer goods. By the early 1970s, about one-third of the index was made up of industrial stocks, showing how important sectors like manufacturing and transportation were back then. As the economy shifted towards services, sectors like finance, healthcare, and tech started to grow in importance. In the 1990s, the tech boom really took off, with companies like Microsoft and Intel leading the way. By the 2000s, tech became the biggest sector in the S&P 500, and that trend has only continued. Big names like Apple, Amazon, and Google reshaped the index, putting tech at the top. Today, tech is still the dominant force in the S&P 500. Meanwhile, sectors like energy and industrials have become less influential, though they're still important. The index keeps changing as new industries rise to the top. As the S&P 500 evolves, its dividend yield has naturally followed suit. Today, the index boasts a near record low dividend yield of less than 1.5%. While this yield can fluctuate with market conditions, it's been on an overall downtrend for several decades. This decline makes sense when we take a closer look at how the composition of the index has changed over time. In the past, we know that sectors like utilities, consumer staples, and energy, which are known for paying steady, higher dividends, made up a large portion of the index. But as the S&P 500 became more tech-heavy, the overall dividend yield decreased. Major tech giants like Apple, Microsoft, and Amazon, while incredibly profitable, tend to favor share buybacks or reinvesting earnings into the business rather than offering high dividend payouts. The S&P 500 has been an incredible investment and has provided solid returns for decades, but it's important to recognize that its composition has shifted significantly over time, with tech now dominating the index. While the S&P 500 has historically been a reliable long-term investment, it's a smart idea to be aware of what the index consists of, so you know why the index moves the way that it does, and so that you have a better idea of what to expect going forward.